If someone handed me $10,000 to invest right now, in August 2025, I wouldn't put it all in one stock, I wouldn't try to time the market, and I definitely wouldn't chase whatever's trending on social media. Instead, I'd follow a systematic approach that balances growth potential with risk management. Here's what most people get wrong. They think investing $10,000 means finding the next Tesla or Bitcoin and going all in. But smart investing isn't about hitting home runs. It's about consistently getting on base and letting compound growth do the heavy lifting over time. Today, I'm walking you through exactly how I deploy $10,000 in the current market environment, including my specific allocation strategy, the exact investments I'd choose, and the timeline I'd follow. This isn't theoretical advice, this is the actual portfolio I build with real money. By the end of this video, you'll have a complete blueprint for investing $10,000 that you can implement today. Hit that subscribe button because I'm sharing real investment strategies every week that you can actually use to build wealth. Before diving into specific allocations, let me share how I'm viewing the market in 2025. We're dealing with several key factors. Interest rates that have stabilized after years of volatility, inflation that's moderating but still present, and stock valuations that are high by historical standards but not extreme. The AI revolution is creating massive opportunities in technology, while also disrupting traditional industries. International markets are offering better valuations than US stocks. And cryptocurrency has gained institutional acceptance while remaining highly volatile. Given this environment, I'm focusing on diversification across asset classes, geographic regions, and time horizons. I want exposure to growth opportunities without taking unnecessary risks with money I can't afford to lose. This isn't about predicting the future. It's about positioning for multiple scenarios and letting market forces work in my favor over time. My $10,000 allocation strategy. Here's exactly how I'd split the money. 40% US total stock market, $4,000. This forms the foundation of the portfolio. I'd use FZROX, Fidelity Zero Total Market Index Fund, or VTI, Vanguard Total Stock Market ETF. This gives me exposure to the entire US economy, large companies, small companies, growth stocks, and value stocks. The US market has been the global wealth creator for over a century, and despite high current valuations, I still believe in long-term American economic growth driven by innovation, demographics, and strong institutions. 20% international developed markets, $2,000. I'd use FTIHX, Fidelity Total International Index, or VTIAX, Vanguard Total International Stock Index. European and Japanese markets are trading at more attractive valuations than US stocks, and international diversification has historically improved risk-adjusted returns. This allocation captures growth from economies outside the US, while providing some currency diversification and exposure to different economic cycles. 15% emerging markets, 1,500, through FPADX, Fidelity Emerging Markets Index, or VWO, Vanguard Emerging Markets ETF, I'd gain exposure to faster-growing developing economies, including India, China, Taiwan, and Brazil. These markets are riskier, but offer higher growth potential and are trading at more attractive valuations than developed markets. The allocation is smaller due to higher volatility and political risks. 15% technology-focused growth, 1,500. I'd split this between QQQ, Invesco QQQ Trust tracking Nasdaq 100, and a small allocation to an AI technology ETF, like BOTS or Robo. Technology continues driving economic transformation, and I want concentrated exposure to this trend. This allocation captures the ongoing digital transformation, while acknowledging that technology stocks can be volatile and may already be reflecting high growth expectations. 10% Treasury I bonds or high-yield savings, $1,000. Not everything needs to be invested aggressively. I'd keep 10% in Treasury I bonds for inflation protection or a high-yield savings account earning 4 to 5%. This provides stability and liquidity for emergencies or future opportunities. This allocation serves as both portfolio stabilizer and opportunity fund for when better investment opportunities arise. You might notice I didn't allocate any money to cryptocurrency. While I'm not anti-crypto, with only $10,000 to invest, I prefer focusing on productive assets that generate cash flows and have longer track records. If this were $50,000 or more, I might allocate 5 to 10% to Bitcoin or Ethereum. But with limited capital, I want maximum exposure to businesses that are creating value and growing earnings. That said, if you're younger with higher risk tolerance and already have emergency savings, replacing some of the emerging markets allocation with crypto could make sense. I wouldn't invest all $10,000 on the same day. Instead, I'd use dollar cost averaging over 3 to 4 months to reduce timing risk. Month 1, invest $3,000 split proportionally across all categories. Month 2, invest another $3,000 using the same allocation. Month 3, invest $2,500 continuing the same approach. Month 4, invest the final $1,500 to complete the allocation. This approach reduces the risk of investing everything at a market peak, while still getting money working relatively quickly. I'd use either Fidelity or Vanguard for this portfolio, since both offer excellent low-cost index funds and ETFs with no transaction fees. Charles Schwab would be my third choice. For account type, if this were retirement money, I'd use a Roth IRA to capture tax-free growth. If I needed potential access to the money before retirement, I'd use a taxable brokerage account. The key is choosing a platform with low fees, good research tools, and the specific funds I want to use. I'd review and rebalance the portfolio annually, or whenever any allocation drifts more than 5% from target. This forces me to sell winners and buy losers, the essence of disciplined investing. For example, if US stocks outperform and grow from 40% to 50% of the portfolio, I'd sell some US stocks and buy more international or emerging markets to restore target allocations. This systematic rebalancing removes emotion from investment decisions and ensures I'm always buying low and selling high relative to each asset class. I'm not trying to pick individual stocks because I don't believe I can consistently identify winners better than the market. I'm not timing entry and exit points because timing the market reliably is nearly impossible. I'm not chasing trending investments because by the time they're popular, it's often too late. I'm also not putting everything in the safest investments because $10,000 invested too conservatively won't grow enough to make a meaningful difference in my financial future. This allocation assumes I'm investing for long-term growth with at least a 10-year timeline. If your situation is different, you might adjust. Age 22, increase technology allocation to 25%. Reduce bonds to 0%. Age 45, increase bonds to 20%. Reduce emerging markets to 10%. Conservative investor, increase bonds to 25%. Reduce emerging markets to 5%. Aggressive investor, increase technology and emerging markets. Reduce bonds to 0%. The key principle remains the same: diversification across assets, geographies, and risk levels. Based on historical returns, this portfolio might average 7 to 9% annually over the next decade. That would turn $10,000 into $20,000 to $25,000 in 10 years, or $43,000 to $58,000 in 20 years. These aren't guarantees. Markets are unpredictable in the short term. But this diversified approach has historically provided solid risk-adjusted returns over long periods. My $10,000 investment strategy prioritizes diversification over speculation, consistency over complexity, and long-term growth over short-term gains. It's not the most exciting approach, but it's designed to build wealth systematically while managing downside risk. The most important factor isn't the perfect allocation. It's actually starting and staying consistent. A good plan implemented beats a perfect plan that never gets started. This allocation reflects my current thinking based on market conditions in 2025. But the underlying principles of diversification, low costs, and long-term focus are timeless. How would you invest $10,000 differently? Let me know in the comments, and if this allocation strategy was helpful, hit that like button and subscribe for more practical investment guidance. Remember, the best investment plan is one you can stick with through both bull and bear markets. Build your portfolio, then let time and compound growth do the work.